Hello everybody, welcome back to another stock analysis video. The second one for today. We are going to be analyzing, guys, the company United Airlines. So this is going to be an interesting one because, again, we all know what happened in 2020 and airlines got completely crushed, right? And seeing that their earnings are, of course, tomorrow, the same time as Tesla. So after close, let's analyze this company, guys, and see what we can learn if maybe we would like to invest in this company at the current share price, looking at it through a fundamental lens. So with that said, let's get started with this analysis. We are going to jump right into the calculator, guys. UAL, United Airlines, doesn't actually pay out a dividend, which in this case, thank God they don't, right? Ticker symbol of UAL, market cap of $13.5 billion, PE of NA. This is not something that's wrong with the calculator because, I mean, I could easily put right here Microsoft and we get a PE right there, right? This is pretty much just telling me that UAL hasn't been profitable within the past 12 months. And with the current share price of $41.47, I can't make a determination based on PE whether or not this is a good price right now. So we're going to take a look at other metrics to come up with a further analysis. Now, they don't pay out the dividend, which is good because looking at these two cash flows right here, guys, the 5-year and last year's, it is in the negative. It's not looking good. Let's take a look at their fundamentals. Starting, of course, with the net income, as always, guys, 5 years ago of $2.1 billion to 1 year ago, guys, of negative $2 billion. That is a decrease of 192%. Now, I understand that this is a decrease on the 5-year, but we all know what happened 2 years ago, and as you can see, it got crushed, right? As I said at the beginning of the video, the company got crushed, all airlines got crushed, so did cruises, everything got crushed. And this is reflective here in their net income where they did $7.1 billion. Sorry, negative $7.1 billion. So to their credit, guys, even though yes, on the 5-year this is a decrease, look at it this way, right? Negative $7.1 billion to negative $2 billion. That is a very, very good increase in their net income from just 1 year after essentially the entire world shutting down. Do I think airlines are going to go away? Probably not, right? I don't think the airline industry is one of those that's very, very difficult to get in. So the ones that we already have, like the main three, Delta, United Airlines, and American Airlines, I think that they're not going to go away anytime soon. Now, guys, looking at the free cash flow, cash from operations, less your capital expenditures, the most important profit metric, because this is the one that companies use to do everything, right? This is the one that companies use to pay down their debts, buy back shares, issue a dividend, which they don't, to make acquisitions, and to just grow the company in general. So, looking at the cash flow, guys, we want this to be positive, and better yet, we want it to be staircasing upwards. Unfortunately, UAL 5 years ago of negative $400 million to 1 year ago, guys, of negative $40 million. Now, while this is an increase on the 5-year of 90%, they do have a negative average 5-year free cash flow of $364.2 million. Now, looking at this graph, guys, you can see 5 years ago, they did negative. 2 years ago, they did negative again. And 1 year ago, they went negative again. These two right here, 2 years ago and 1 year ago, same reason as the net income. COVID essentially happened, right? My concern is this 5 years ago, what in the world happened here that made their cash flow go negative? And in fact, looking at these cash from operations, less your capital expenditures, it actually isn't that bad as you would think because, well, it's not that they did negative cash from operations, which is not something that you want. They just exceeded their capital expenditures instead. So this is pretty much just saying that they put in a lot of money, they invested a lot of money back into the company this year, which is why their cash flow was in the red, right? So it's actually a little bit more understandable as to why this happened, but nonetheless, I would do more research as to where this capital expenditures went to. These two numbers, 2 years ago, 1 year ago, COVID related, I would just essentially ignore it. But nonetheless, even with that, this graph isn't looking that good anyways, because the only two positive years were 4 and 3 years ago, and they were roughly at around the same, at around 2.1, $2.4 billion. And now guys, looking at the revenue 5 years ago of $37.8 billion to 1 year ago of $24.6 billion. This is a decrease guys on the revenue of 34.8%. So this is actually again fairly explainable with the fact that we had COVID, right? We see 2 years ago they dropped down by more than half actually, right? 3 years ago it was $43.3 billion, and then 2 years ago it went down to $15.35 billion. So again, this is a COVID related thing, and they are recovering fairly good from 2 years ago to 1 year ago, but nonetheless guys, from all intents and purposes, I would just ignore these numbers, mainly because of the fact that we're still under some lockdowns around the world and there are still restrictions. So unfortunately, do I foresee this number to get better in the future? Yes, but it's gonna take a couple of years for it to get to the 3 year ago mark. Now analyzing some balance sheet numbers in total assets minus the total liabilities. If we go into a recession, guys, can the company cover their liabilities with their assets? Actually, not even if we go into a recession, if we have a pandemic, right? Can the company's assets cover their liabilities? As you can see right here, this actually did exactly what it needed to do, right? Currently, they are able to cover this with a difference of $3.6 billion. However, notice this, from 5 to 3 years ago, it was increasing fairly steady. And then COVID happened, and essentially their liabilities started to overtake their assets. In fact, looking at the total assets minus the total liabilities right here, we can see that their actual assets continued to grow, but their liabilities unfortunately grew significantly more. Still under their total assets, but nonetheless, it still grew exponentially more than their assets did. So that is essentially why we are getting this downtrend after COVID, right? Average total assets is around $56.8 billion. Average liabilities is around $49 billion. And doing this difference, guys, we get around $7.5 billion. And now let's take a look at if their cash flow is able to cover their liabilities. And as you can see right here, it cannot. We are essentially taking their cash flow from up here and then subtracting that minus the liabilities. Now, obviously, we saw right here, right? Their cash flow was negative 40 million and then negative 5.8 billion. So expect these 2 years and of course the 5 year ago number to be deeply in the red because the cash flow was in the negatives, right? You subtract a negative minus a negative, you're going to get an even more negative. So unfortunately, this graph is decreasing, guys. And 1 year ago, they had a difference of negative $63.2 billion. Let's take a look at this average cash flow minus the average liabilities. We get around negative $46.4 billion. Now looking at the shares outstanding, a metric that unfortunately companies tend to fail because, well, companies, when they start to get into a tailspin, they tend to issue shares to try and recuperate some cash so that way they can continue to grow. However, in doing so, they dilute you as the investor, and it is not good in the slightest. When it comes to UAL, so you can see it is an increase 5 years ago of 287 million shares to today, guys, of 326.7 million shares, increase of 13.83, and from the previous year to the current year, it is an increase of 0.9%, going from 323.8 million shares to 326.7 million shares. Nonetheless, even though the reason why this occurred, it just so happened that 2 years ago is when they issued a bunch of shares going from 251.2 to 311.8. It was because of COVID. It is still a dilution nonetheless. And lastly, looking at the cash and equivalents, they currently have around $18.5 billion in cash and equivalents with an average cash of around $9 billion. Alright guys, now let's come over here and make some assumptions, low, medium, high, using 3 different factors. As always, revenue growth, projected share buyback, and of course, the required rate of return. So, let's take a look at the first of all, revenue growth. Let's come over here to Seeking Alpha and see that the revenue growth year over year, guys, it is 173.5%, and the revenue growth forward is estimated at 47%. I cannot, in good conscience, say that these things are accurate in any way, right? Because unfortunately, Airlines still has competition, right? They are not a monopoly. They still have a lot of competitions with other airlines. I mean, American Airlines and Delta are the 2 other biggest. So I cannot say that they'll grow at 40% within the next 4 years, especially since a couple countries are still locked down with severe restrictions on their travel, right? So I need to take this into account and be conservative with my assumptions. So for the low assumption, I'm going to say that they'll grow at a revenue growth at around 20%. For the medium assumption, let's say 23%. And for the highest assumption, let's say 26%. Now for the projected share buyback, guys. We just saw the shares outstanding that it was roughly at 14% or so. So for the lowest assumption, let's say that they'll continue to issue shares a little bit more than they did within the past 4 years of -15. The negative just means that they're going to issue shares. Let's bring this down now to -12% and bring it back down again to -9% for the median and high assumptions respectively. Now with this, we get the target share prices, not adjusting for debt, of $17.11 for the low assumption, $19.30 for the median assumption, and $21.74 for the highest assumption. Now adjusting for debt, taking a look at the cash equivalents, adding the net debt. If they have more debt than cash, then obviously this number comes down. If they have more cash than debt, then this number comes up. It does come down, guys, to $8.78 for the low assumption, median assumption of $10.73, and high assumption of almost $13. Now adding a margin of safety on top of this target share price after debt of 5, 10, and 15%, we get a target share price between $7.46 to $8.34. For the low assumption, for the median assumption, it is $9.12 to $10.19. And for the high assumption, it is almost at $11 to $12.27. Guys, the current share price is $41.47. So whichever way you look at this is still overpriced and according to my assumptions right over here. Again, my assumptions, right? You guys can change these to whatever you want. For example, let's just say that you believe that UAL would actually grow at, I don't know, I was seeking off a saying, let's say around 50%, right? Smack in the middle, a little bit higher than the year over year, but significantly lower than the over year, right? And let's say that you think that, well, actually, right then and there, just with that revenue growth assumption, we can see that the target share price, not adjusting for debt, would be $42, right? At this point, you would think that the current share price is a pretty good value right now in the target share price, not adjusting for debt. So this is just a way to show you guys that every investment is the present value of all future cash flow, and that none of this is financial advice. You guys should make your own assumptions. That's why I have this calculator available for free, as well as my book value one, the REIT one, which I still have to update. You know, don't get me wrong. Hopefully I'll be able to get to that this weekend, as well as a dividend tracking sheet as well. All I'm asking for in return, guys, is help me grow my channel. Like, subscribe, comment. Thank you so much for those who have subscribed. Really enjoying making these videos for all of you. Hopefully we can get to 1,000 subscribers by the end of the year. That would be awesome. All in all, guys, when it comes to UAL, this is a company that, well, I probably would have bought it, honestly, before COVID. I did have Delta Airlines before COVID, and then right when it was starting to happen, I was just like, I think this is going to be a whole lot bigger than what we think, and I sold it, and thank God I did, right? So I probably would have bought this before COVID, but looking at it now, guys, currently it does not justify a buy for me. They still need to recover from the COVID fiasco. Now, if you guys believe, right, that they'll grow a significant amount more than what I said in my assumptions, then this might actually be a pretty good stock to buy right now. But in my personal opinion, according to what I believe, it still needs to fall to around the price tags that I said. That pretty much does it for this video. Like if you like, comment, subscribe. As I said, you guys can follow me on my new tech sites, link in the description below. So with that said, peace out, and be on the lookout for the next stock analysis video.